Our next guest says DeepSeek is a legitimate disruptor. He's out with a new note highlighting 3 bad signs for the market that could even push the S&P into a correction later this year. Barry Bannister is chief equity strategist at Stifel. He's got the lowest year-end target on the S&P across Wall Street at 5,500. Nancy Tengler is still with us as our guest host. All right, Barry, I think you and Nancy, you are like 2 very different points of view here, so this could be fun. But give us I hate to call it the glass half empty take, but explain to us how you see a path towards a significant correction here.
Yeah, keep in mind that even on a good micro story, macro sometimes rules. And the market's pretty much ignored the macro on the AI hysteria the last, year. But the macro is starting to catch up. Inflation is sticky. I don't think the Fed's going to cut rates again. Frankly, the 10-year yield's too low if inflation proves very sticky and the Fed doesn't cut. And price earnings multiples just got too high. And I think we had to let some air out of the balloon. And we come down on the side of about 10% lower by the late 2025.
So, Barry, you don't look at this and go, power stocks 30% off, leading chip stocks 20% off. This is a top 3, as Dan put it, buying opportunity.
No, it's definitely not a buying opportunity. I have some trouble with the way that the big tech companies with monopolistic cash flows are redeploying the cash from a high ROIC business to a low return on capital business. Even if it has the unit sales growth and the initial build out of the models to the S&P 500 type companies, it's going to have a very competitive landscape. And are they going to earn this capital return that they need, or should they have just given us the money back instead of spending it?
Barry, it's Dom. One of the big questions facing many investors today is this fear that this could be the triggering of a larger sell-off, one that we haven't really seen in quite some time now, aside from the 5% pullback that we got over the last couple of weeks entering here. Is there anything that would suggest to you that anything else could trigger any kind of a broader market decline at or near record highs like we are right now?
Well, over 30 years ago, we used to joke about how technology was such a displacement event business where new competitors would come in and destroy the entrenched stocks, that it deserved a lower multiple because of that. It's a short life cycle business that's got a very short competitive advantage period. But investors forgot about that. They bid up the stocks. The growth relative to value, large cap total return, one divided by the other on a 10-year compound basis, reached the absolute outer limits of the past 90 years. And that exact limit line is exactly where it peaked, the price earnings multiple and the outperformance of growth. So for us, it's just a very bubbly, ebullient market that's just got to take some air out of it.